Alright boys, what is good? So I'm back again with some more free source on the liquidity supply and demand strategy because everybody's trying to learn it right now. And today the source is on how to find the highest quality setups using the strategy because of course everybody's trying to increase their win rate, and I get a lot of messages over the Discord etc. just about setups they've taken and lost on, and a lot of the time they're just not quality setups and I just would not have taken them. So I've realized that maybe a lot of people don't know about these things, so hey, I'm here to go through it today. And yeah, let's go. But first, actually, if you aren't familiar with the strategy, then I'd definitely recommend you watch my full breakdown video at some point because it basically goes through the whole strategy and most of the stuff you actually need to know. But yeah, the first thing you want to know in order to spot the highest quality setups using the strategy is to do with the liquidity aspect of it. So as we know, what we're looking for our liquidity supply and demand setups to be valid is a push up, creating a demand zone, a retracement that doesn't tap the zone, then for price to come back up, breaking the high that made the liquidity, if that makes sense. Then to come down to our zone, give a good reaction, and then hopefully go up. Now, the retracement right here is of course the liquidity. However, there are kind of multiple kinds of liquidity when using the strategy, some being much more convincing than others. So that's what I'm going to go through first. So firstly, we have one candle liquidity. It's basically when price goes up, creating our demand zone, and then the retracement that we need to see is just one candle, and then it just instantly goes straight back up. Now we consider this low quality liquidity. The only time that it's really valid is if it creates a very nice, like obvious demand zone for normal supply and demand traders to enter in at, because then they'll have their stop losses below the zone. And this is a pretty good example of that. But other than in that situation, I'd recommend you stay away from one candle liquidity for the most part, because there's no real liquidity below this candle outside of it creating a demand zone, because it's not exactly like a swing low. But for this example right here, we likely gave somewhat of a reaction from here. People would be entering. I'm sure it was giving rejections at some point. Normal supply and demand traders are in, their stop losses are below this zone, and we just use that to fake out to our zone. Obviously, if you know how the specifics of the strategy works, then you know we enter on the bullish close in our demand example. And for this trade, you can maybe just go for a 1 to 3. If there's anything to the side, maybe go for a 1 to 5. Actually, yeah, 1 to 5 works. Maybe TP1 at 1 to 3. And let's see. And yeah, I mean, that would have hit. Obviously, I knew that. I'd specifically picked out the setup. But this is a good example of a one candle liquidity winning. But for the most part, I'd recommend you stay away from these. This did create a nice demand zone, but even then, I'd be quite iffy on it. So this would be a setup that I'd be slightly questioning, but I would still take. What we should really be looking for is 2 candle liquidity or higher. Now, what I mean by this is we get our demand zone be created. We've had this large push up, and then price comes down with 2 black candles. So this is 2 candle liquidity because this is our level of liquidity at the moment, at least. And what this does is it creates a more obvious swing low. And as we know, swing highs and swing lows are very obvious places for liquidity to be. And a lot of the time, when it does create this 2 candle liquidity, it will also create another demand zone in order to fake people out. In this example, it hasn't, but if it does, that's just even more confluence. Now, once again, might as well just go through the trade, just as a good example to show you just how I'm trading still. Had a little bit of consolidation here. Entry has not been given. Oh, there it is. Entry would have been on this candle. Stop loss 1 pip below. And honestly, this is a really good entry. Could probably get a very high RR trade, maybe even max out at 1 to 10 at the swing. Should probably have a TP1 at the first high. And we nearly get stopped out, but that's why we give 1 pip room. And I do know this wins, but might as well show it. So yeah, that's 2 candle liquidity. Obviously, it doesn't have to be 2 candle. It could be more than that. This is just an example of perfectly 2 candles. This could have come down a few more candles and it would have been even better if anything. But yeah, that's that. Now, finally, in terms of liquidity, there is one thing that's kind of nicer to see than that. I couldn't really find an example. However, what we'd be looking for is a level of consolidation. So we go into replay mode here. So in a situation like this, if instead of going upwards straight away after this, something even nicer to see would be if we continue coming down a little bit and then just consolidated for a while before going up, of course, breaking this high right here. If not, it wouldn't be valid still. But of course, this creates a very good point of interest for investors to put their stop losses below, as price seems like it's struggling to break past it. So if you were buying, it would seem like a good place for you to think your trade is just done. It's also a very obvious low, like compared to, let's say, this low right here. Something like this would stick out much more as somewhere that you could put your stop. Also, it gives more time for investors to realize it. So basically, more liquidity builds up in these areas. And so when we finally come down and tap our zone, we have filled in all the necessary requirements for price to fully want to commit in moving in our direction. We've taken the majority of the liquidity out in the area. We've broken highs showing direction. We've come down a significant amount of pips in order to give investors the best price. So all we wait for is a good rejection and hopefully win. The next thing I want to talk about is which zones you should be taking. Now, I have talked about this before, but I know it can be confusing to know which zones you should be taking and which ones you should be avoiding. So I'm going to go through this again because people be asking the same questions. And I actually think this is the exact same example I used the first time as well. But I'm here to help. Obviously, that's the whole point of the video. But anyway, with something like this, there's quite a few zones. If we go back even further real quick, you can see we have like a zone here, I guess. We have a zone here, we have a zone here, and then if I come out a bit, we even have a zone down here. So basically, we got options. We got hella options right here. And when you're overwhelmed with these options, you may be just thinking, which one's best, which one should I take, or if you should take all of them. But we have a general rule that you can stick to for the most part, even though sometimes it isn't exactly law. So first, the top zone is decent. So the top zone right here, I mean, this isn't like a great zone because it's fucking tiny, but imagine it wasn't. Just in general, the top zone is usually decent because price can come down to it and just continue upwards. We see this all the time where price won't fully mirror like a massive push like this, and instead it will just create some kind of level of consolidation and then continue up. Like all it's really doing is just building up orders in order to continue the continuation. Then we have the bottom zone. I'll go through this next. Realistically, this is the most ideal of the zones. This is because this zone has the exact same qualities as the others. Obviously, we have our level of liquidity, so do all the other ones. We're still following trend, etc. However, the only difference is we have a much larger retracement in order for the continuation to continue. Why do I keep saying this? But basically, way more investors will be entering here because they get a way better price. So let's just go to the closest other zone. So why would an investor most of the time enter at this zone right here when we could get another 140 pips? Obviously, this might not be a great example because I actually don't hate this zone right here. But for the most part, the bottom zones are the most ideal. I mean, even though I said I don't mind this zone, I'd still prefer this bottom zone. There's just going to be way more investors entering here, probably larger positions. They're getting a way better price. And that's why we often see just massive reactions from zones like these, even though a lot of the time they'd be made like a week before. And as well, for us, this is just way more beneficial because we're just able to hit way higher TPs. I mean, just look at the TPs would likely be hitting if we entered at this zone. Let's say it'd be around there. Once again, this is a weird zone because it's so small. This would be a decent entry. At the high, that'd be like a 1 to 4. That's a pretty good trade. And that's being pretty generous. Entry would likely be higher, so it might be like a 1 to 3. But if price came all the way down to the bottom zone, we'd likely be having entry around the same spot. Let's say around the same amount of pips, and you can catch something massive with this because it will just be correcting the whole movement that it made to get down there. And obviously we can presume that it's going to continue up because we're just not breaking lows and we are breaking highs. So that's another reason why the bottom zone is just nice. But then we have the middle zones. Typically we avoid the middle zones. Now, like I said, there are some cases and situations where we will take the middle zones. This one right here, actually, I quite like, even though it technically is the middle zone because we have this one down here. However, usually it is lower quality than if you were to take the top or bottom zone. This is because we can assume price will either do what I said, just make a little consolidation and then continue up, or it will make the full retracement down to the bottom zone, leading to the best reaction, the most amount of pips, and a bigger win. But yeah, hopefully I didn't make that too confusing. Hopefully I didn't waffle too much, because now we're about to talk about, yes, I have this noted down, trend, higher time frame stuff, and key levels. I'm probably going to waffle a little bit about this because I don't know how to fit them into separate pieces, but it's going to be some important shit, so trust. So the reason I'm going to put these all into one is because I can kind of talk about them all at once. So right here, we have what we can consider to be a downtrend, okay? I think it's pretty obvious. Going down, going up, going down, going up, going down, okay? Pretty undeniable downtrend. We've been going at it for a while as well. This is a 30-minute time frame. However, even though we're in a downtrend, something may still stop us from taking supplies, for example. Now, once again, this may not be the best example because we actually are currently reacting quite nicely off the supply right here. This could be a nice liquidity supply and demand one. I actually am in this position just because the reaction was beautiful from the zone, but I'm still going to talk about this anyway and use this as the example. So basically, key levels, we have created sort of a triple bottom here. The only reason I did take this trade is because we did break this low over here. If you can see it, we did break this low, so I was cool with taking this, but I'm still somewhat concerned about it. And that is because, once again, we have this kind of triple bottom going on right here. And if we just go into the higher time frames, you don't really have to, but you can pretty easily go into the higher time frames, look back somewhat and see where we're at now. So this triple bottom, if you extend it further, we've actually had a very harsh reaction from there before. This is basically the exact same area that we reacted from right here, especially with these wicks here. And this almost stopped me from taking this trade because, I mean, I feel like you can look at this and tell that this is like an area that we could definitely just go bullish from. We'll see in the coming weeks if this does fully go bullish from this. I wouldn't be surprised at all, but let's hope this trade can win first. Maybe I should have recorded a live trade. Hey, fuck it. You know what? If you want live trades to come back, like the video. comment something, and I'll probably bring them back, maybe. It's been a while, man. It's been ages. But anyway, as I was saying, another thing that we could be looking for that may make us want to not take a trade or take a trade is just seeing higher time frame key areas once again. So seeing where we react from levels like this, if you came down to here, or just right at the bottom here, or just like demand areas like this. If we react harshly from then, you may want to avoid taking supplies. I see this all the time where it looks like we're just very bearish. We'll even get a big retracement, so it looks like it could just be like a very nice trade, good reactions, and it will just fake out because we are just reacting from a key area on the higher time frames. Like for example over here, we can see we're in a just very big downtrend once again. However, we can see we start moving up. We're actually breaking highs, not really breaking lows. So you could think we're starting to go bullish. However, when we get to certain points, such as this high over here, you can see we start reacting pretty harshly and we completely flip bearish. These areas are just very good to keep note of all the time, because I'm sure if not, there'd be a lot of people looking at, say, this zone down here. I'm not sure if that was tapped, but actually it is not tapped. So yeah, people would probably look at this zone here, maybe be entering on this bullish close, and they'd be like, oh my god, this is a great entry, let's go. But you're reacting from a key area. Not only that, but we're also reacting from a liquidity supply and demand zone up here. So you got to be looking for key areas. There's so many low quality trades that you're probably taking if you're not like doing too well with this strategy. Now obviously this doesn't mean go looking for every reason not to take a trade, but when it's something obvious like this, where we're reacting heavily from a key area like this, we've got a liquidity supply and demand zone that we're just shooting down from, don't try to take demands because we're going to go into a downtrend. Like even right here, if somewhere further back, I can't actually see further back, but if we had reacted from this spot one more time, I'd potentially be looking for buys right here, you feel me? Like maybe I would consider something like this when it gave entry, but I mean if it's only tapped twice, maybe not so much. But these are the areas you got to be looking at. You can predict like the coldest reversals, which give you, I mean, the most insane TPs. Like if you can predict a reversal from the start, brother, 1 to 10, easy. But yeah, obviously you got to be pretty good with this. I'm still improving with all this, all like the key levels and trend stuff. I'm not 100% on it yet. I am far from perfect myself, but we all improving, and this is just my knowledge. And yeah, I don't really have much else to talk about. Let me know what videos y'all are trying to see in the comments, because hey, I'll just do what the people want to see. And yeah, I'll see you next week. Peace.